Welcome back. Next module, performance measurement. Previously we have learned that it is the duty of the management accountant to analyze the actions and activities of an organization and evaluate and interpret the results accordingly. So measuring the performance, in simple terms, if you go through the financial statement, you can see that by mere understanding of profitability of the organization, that is net profit or net loss, and the position of the balance sheet will give a glimpse into the performance level of the organization. But as far as an organization is concerned, whether it is a large scale business or a small scale business, mere understanding of profitability or position will not give a detailed picture regarding the performance of the organization as a whole. In that case, we need to study in detail the various areas or divisions within the organization and to identify the performance of each individual points of areas within the business. Then only we can pinpoint the issues or flaws within the organization. So, the important function of management accountant is to evaluate the performance of the company. This involves the measurement of the performance of the divisions of the same company or assessing the performance and stability of the whole company. Meaning of performance measurement. Performance measurement, in simple terms, is the process of collecting, analyzing, and reporting the information regarding the performance of an individual, group, organization, system, or component is known as performance measurement, and it is one of the important functions of a management accountant. So in general, we can say it is the process of evaluating the performance of the divisions of a company or the company as a whole. Next one, measures or methods to measure the performance. For evaluating of performance, benchmarks or yardsticks are needed against which achievements are to be compared. Such benchmarks or yardsticks are known as measures of performance, and in this area you will be discussing different tools and techniques for measuring performance as well as yardsticks or benchmarks. We will discuss in detail each measures or each tool so as to measure the performance. Let us discuss about the characteristics of measures of performance. The measures of performance should have the following essential characteristics, such as measures should evaluate progress towards goals and objectives of the organization. They should be reasonably objective and easily ascertainable. There should be a balance between long-term as well as short-term considerations. They should reflect key activities of the management. The employees of the organization should have awareness about the performance measurements. The measures should be understandable to the employees. All the persons or divisions whose performances would be measured should be provided with information relating to the result in time and on a regular basis. Let us discuss some of the reasons for the purpose of measuring performance. The fundamental principle behind performance measurement is to improve performance. According to John Ben, he has given 8 reasons for adopting the performance measurement. Let us discuss each of the reasons. To evaluate how well the organization is performing. To help managers ensure that their subordinates are doing the right thing, to help in budgeting as well as forecasting, to motivate the people in accomplishing the goals, to celebrate the achievements of goals, to help in promoting the competence and value of government in general. To learn reason behind poor as well as good performance. So these were the characteristics and at the same time reasons for the requirement of measures of performance within an organization. And let us see how the organization's performance is measured. All measures of performance may be broadly classified into two main categories: financial measures as well as non-financial measures. As the name suggests, one is based on financial terms, another is based on non-financial terms. So let us discuss in detail each individual category. Financial performance measures. It is the most common pattern for measuring the performance. For evaluating performance, it is quite essential to measure the financial performance. The financial performance is a subjective measure of how well a firm can use assets from its primary mode of business and generate revenues. The term is also used as a general measure of a firm's overall financial health over a given period. The financial performance identifies how well a company generates revenue and manages its assets, liabilities, and the financial interests of its stakeholders. There are several measures to evaluate financial performance. The important financial performance measures are ROI, residual income, EVA, and cash flows. Even though there are many methods or tools for measuring the financial performance of an organization, these four are the most important tools for assessing the performance of the organization. So let us discuss in detail each of these tools along with its mathematical applications. So let us begin with first one, ROI. And remember, the financial performance measures such as ROI means return on investment, residual income, EVA, and cash flows. These are known as traditional financial performance measures or backward looking methods. So let us discuss in detail each of these measures. First one, return on investment. ROI is widely used to measure the divisional as well as overall corporate performance. ROI was developed by a financial executive of E.I. DuPont de Nemours and Company in 1919. It considers the level of investment along with the income generated from that particular investment. When a firm invests money in a business, it naturally expects adequate return on its investment. Therefore, the firm wants to know how much profit it is earning in its investment. It is for knowing this ROI is computed. ROI measures the overall profitability and establishes the relationship between profit on return and investment. It is also called accounting rate of return, and the equation for finding the ROI is profit before interest and tax divided by capital employed into 100. Here the profit before interest and tax, the other name of that one is EBIT. You might have familiar with the term earnings before interest and tax, otherwise known as operating profit. Usually this ratio is expressed as a percentage. ROE is also known as rate of return or return on capital employed. The overall profitability ratio, in another terms we can say ROI, may be said to emerge from two other ratios, that is operating net profit ratio and capital turnover ratio. And first one, operating net profit ratio, the equation is operating net profit divided by sales into 100. Why we are using this equation is to measure the operating performance. And at the same time, we will be using the equation capital turnover ratio, equation sales divided by capital employed. We use this equation to measure the asset utilization. By merging these two equations, we have developed a return on investment. So if you look closer, you can see that operating net profit divided by sales to 100 into sales divided by capital employed. If you multiply these two cases, the sales and sales will be cancelled, and the remaining numbers or values are operating net profit divided by capital employed into 100. This is how we have developed return on investment equation. So actually, return on investment equation covers operating net profit ratio and capital turnover ratio. So before we going further into the application level, just brush up your areas of study, such as the materials which you have learned in the 5th semester BCom. Try to go through the ratio analysis equations as well as financial management equations. We will be discussing in detail all these areas in the same module in the coming sessions. So we will discuss about the further aspects in the next one.